All right. Good morning, everybody. Good morning, everybody, and happy Thursday, everybody. Today's May 30th, 2024. There is a lot going on this morning. The big story was Salesforce, one of the leaders in cloud computing, cloud software. It's been one of those mega growth companies for several years now. Kind of one of the smaller competitors with Amazon and Microsoft for cloud software. They are getting clobbered this morning, mainly because they posted a beat yesterday. It wasn't a terrible quarterly result for Salesforce, but they guided for their lowest growth, single-digit revenue growth for next year, which still, hey, is still a growing company, but that was the slowest growth guidance in the history of Salesforce. In particular, the company is citing slower customer demand, weaker headcount growth at their customers. In other words, it kind of looks like a slowdown in the labor market. And well, when you're a big growth company and your growth starts to stall and people start to look at you not for what you might be earning next year, but what you're actually earning this year, your valuation starts to drop very rapidly. Pay attention, AI investors. This is what happens when growth shifts somewhat towards value. Salesforce is getting clobbered today. Now, their forecast was still pretty good, 9.2 to 9.25 billion. The market was expecting 9.37 billion, but it was that single-digit growth that really killed them. Now, when they first reported yesterday, there was this big drive in the financial press to try to say, well, Salesforce is a little behind the AI curve. They've been slow to roll out their artificial intelligence. And maybe artificial intelligence is eating their lunch, and that's why Salesforce is reporting this slower growth. And respectfully, they're full of it. I don't know how you can respectfully say somebody's full of it, but they're just full of it. This isn't an AI story that's going on at Salesforce. This is a slowdown in the job market. Companies are hiring fewer people, and so they need fewer subscriptions for software. That is exactly what we saw with Workday's earnings last week. Shout out to my moderator, Mish, who reminded me of that one. Workday reported lousy earnings last week because of slower headcount growth, driving fewer subscriptions. That is what's happening to Salesforce this morning. It's got nothing to do with AI. This is no longer the kind of market where on a quarterly call, you can just click your heels together 3 times and say artificial intelligence and your stock magically goes up. The world is starting to, at least a little bit, start to see through that nonsense, and they're starting to demand some numbers. And case in point is another one that's going on today, UiPath. That's one of those AI startups. They are down over 30% right now. Now, UiPath is another one of those AI startups. It had a $10 billion valuation somehow. I don't know. But this just reads like a clown show. Their co-founder, Daniel Dines, is taking over and becoming CEO. Now, back in January 31st, Daniel Dines stepped down as co-CEO, and he allowed his also co-founder, Rob Enslin, to take the helm as CEO. And I tell you guys, anytime you hear the phrase or read the phrase co-CEO, danger alarms going off. Co-CEOs, I can tell you, I have seen so many absolute clown shows with companies just going to hell because they tried this power sharing co-CEO thing where, oh, it's great and we're the best of friends and we make decisions together. It never works that way. You end up with indecision and just analysis paralysis. It doesn't work. You need definitive leadership. Well, UiPath is getting clobbered right now on this CEO change. One of their co-CEOs resigned in January, and then I guess the co-CEO who took over as the sole CEO did a lousy job, and so he's stepping down, and the other co-CEO is coming back, and now he's the CEO. And oh, by the way, we lowered our guidance, citing what are they citing? Increased deal scrutiny. Sounds a lot like what Salesforce and like what Workday just told us. What's going on here, guys? There is a slowdown, this white-collar recession that's been going on for pretty much 2 years now. It started pretty much early 2022 with the big tech layoffs. Well, when you have fewer white-collar workers because business is slowing and these companies are laying people off hand over fist to try to streamline their earnings reports, most companies that have laid people off are seeing big earnings bumps. Well, you need fewer software subscriptions. And the companies that sell those software subscriptions, no matter how many times they say AI, they're going to take a hit to their earnings. That's going on with UiPath this morning. And as it happens, just yesterday, I kid you not, Kathy Wood, announced that she was out. There was this article that Kathy Wood was out bargain hunting, and she bought these 3 new names, and at the top of the list was UiPath. Nailed that one, Kathy. Another excellent call there. Also going on this morning, we got a lot of mixed news from banks. All right. Now, yesterday we had Bank of the Ozarks here in the U.S. It's a medium-sized bank, about $4.5 billion, not very big. But their stock was down big, about 14%. There was a big downgrade at Citi for Bank of Ozarks, citing 2 big loans for commercial real estate. This big life sciences development in San Diego and this big mixed-use residential retail office that they have going on in Atlanta. And they're saying that these 2 deals combined represents $1 billion of risk for Bank of the Ozarks. That stock sold off 14% yesterday on that commercial real estate news. We also got a lot of reports from Canadian banks over the last few days. Right? U.S. banks are largely behind us. We've seen most of that from earnings season. Well, the Canadian banks are starting to report, and a lot of them are reporting big loss provisions for commercial real estate. Now, there were some exceptions. A couple of banks actually beat earnings. Canadian banks actually posted pretty good earnings because they're reducing their loss provisions. Now, that's something we saw here in U.S. banks. A lot of banks reduced their loss provisions, trying to say that the bottom is in commercial real estate. It seems like every day another analyst is calling the bottom in CRE, even though the story's just getting going. So I'm very suspicious of banks that beat earnings because they're lowering their loss provisions. That is just a way of juking the stats to make your stock look better. We got Walgreens is in the news again this morning, or another story about price cuts. Walgreens is cutting the price on 1,300 products heading into this summer. Now, we're starting to see a lot of stories like this, guys. Inflation has killed the consumer, and so the consumer has less money to shop, and companies are seeing their market share shrink. And so companies are starting to lower prices in order to bring them back in. We saw that with Target lowering the prices on thousands of items. Walmart is increasing their rollbacks over the summer. And now Walgreens is getting in on it. 1,300 items are going to see price cuts. The solution to higher prices is not the Inflation Reduction Act. It's not electric vehicle battery factories and subsidies. No, the solution to higher prices is higher prices. When prices rise too much and people can't afford them, then the people selling the stuff have no choice but to lower the prices until the buyers come back. It's almost like the inflation problem would go away if the idiot politicians would just let it. And speaking of retail, we got a mixed bag in retail this morning. We got a huge miss was just reported by Kohl's. Massive. Their comps were down 4.4%. That's same-store sales, and those are not adjusted for inflation. So you've got something like 7 or 8% less stuff selling at Kohl's. They also lowered their guidance. That stock is getting clobbered this morning. We also had Best Buy reported, I believe, their 8th consecutive quarter of sales declines. Their comps were down 6.1%, another terrible quarter for Best Buy. Although their stock is doing pretty good, it looks like the market was expecting even worse. And in one story that's got me really scratching my head, Foot Locker stock is rallying like crazy this morning. And you might be sitting there saying, WTF, Foot Locker? Really? It's not like people are going to the mall all of a sudden. Well, Foot Locker stock was up 13% the last I looked. Their comps fell 1.8%, same-store sales down 1.8%. The market was expecting a decline of 1.9%. So I guess Foot Locker stock is rallying double digits because of that 0.1% less decline in same-store sales. Trying to explain it here, guys. I don't know. Look, I'm not joining this go buy Foot Locker thing. Foot Locker is a mall stock, and the mall is just still dying. It's going to get worse. See also commercial real estate losses piling up. But I guess the market was expecting worse than they got from Foot Locker, so that stock is rallying. So we got a lot going on in the world today, guys. We got this white-collar recession causing software subscriptions. We got mixed bags from banks, AI stocks dropping 30%, Walgreens cutting prices, retail is all over the place. Why don't we shrink my big melon of a head? And let's see what's going on in this market, shall we? And guys, don't forget that like button as we're going through the market. And that subscribe button is right next to it. If you're new here, have your coffee with the melon heads every morning. And the S&P 500 is currently down just 14 points or 0.27% here. A little bit in the red. Caught a little bit of a bump at 8:30 when those GDP numbers came out. It was just the second estimate of GDP numbers. We're not going to get into those because there really wasn't any change to the data there. The Dow, meanwhile, another big down day for the Dow. It looks like down 349 points right now or 0.91% and falling here. Tough day for the Dow. And the NASDAQ is doing a little bit better here, down 43 points or about 0.25%. But all three indexes are in the red this morning. Stock's not looking so good here. Meanwhile, we got a falling dollar down 31 basis points or 0.3% lower here at 104.78. And looking over at the bond market, we've got yields are falling notably on the long end of the curve this morning. The 30-year Treasury is at 4.696. That's down almost 5 basis points. The 10-year's at 4.565. That's down almost 6 basis points. That's after rallying pretty fast for 2 consecutive days. So a little bit of a correction there. The 2-year, meanwhile, 4.931. That's down about 5.5 points. And the 1 month is still sitting at 5.378. Looking over at commodities, we got a little bit more red than we've been seeing lately. Let's see, spot gold is at $23.43. That's up about $5 this morning. Meanwhile, spot silver is at $31.46, down 50 cents or about 1.57%. It was down 80 cents at one point. So it looks like Mr. Slammy is in the driver's seat for silver right now. Although $31.66, still pretty good price here. It came down over the last few days. We bounced at 30, moved higher. Now a little bit of a sell-off again. So silver is kind of getting its bearings here. Copper, July copper futures at $4.66. That's down 13 cents this morning. July platinum futures are down about 0.75%. September palladium futures are down 2%. And oil is down this morning, back below $80 a barrel for July WTI futures at $78.44. That's down about 80 cents or 0.96%. Got to look at that silver chart here, guys. So looks like we've got a little bit. It could be a double top here. We failed to break through that resistance yesterday, and now we're down here about 50 cents again ahead of the open. But again, the fact that we caught a nice bounce at $30 here, that was pretty encouraging to see that. So I'm not giving up on this silver rally just yet. I still like the shiny. We've got Bitcoin is doing a little bit better this morning, up $560 on Coinbase at 68,129, but still trading in this range that we've been at pretty much since the middle of March when that initial enthusiasm for the Bitcoin ETFs fizzled out. I would add the BlackRock ETF IBIT just hit $20 billion in net assets. So a lot of money flowed into those Bitcoin ETFs, although right now they're just kind of trading water. Now let's get on to the main story of the morning. Salesforce shares tumble as soft cloud demand hurts forecasts. This is a big one this morning. Salesforce forecast second quarter profit and revenue below Wall Street estimates on Wednesday due to weak client spending on its cloud and enterprise business products, sending its shares down more than 16% after the bell. Weak client spending. That's interesting. It expects revenue between 9.2 and 9.25 billion compared with estimates of 9.37 billion. Salesforce forecast pointed to clients scaling back spending as the possibility of higher for longer interest rates and elevated inflation prompt them to keep costs under control. The company guided its quarterly revenue in the single digits. That's the slowest pace in its history, according to analysts, indicating that the cloud firm's growth has begun to slow after years of breakneck progress. Salesforce has been heavily investing in AI for months and integrating the technology into workflows of its large suite of products to drive revenue and margins. AI initiatives will take time to come to fruition. We are now weary about whether CRM will look to go back to M&A to drive inorganic growth, according to CFRA research analyst Angelo Zeno. So look at that. AI initiatives will take time to come to fruition. People actually starting to ask questions about whether AI is going to make them any money or not. Wow, somebody pinched me. Am I dreaming? Is somebody actually asking questions about this AI mania for a change? That's curious. The company's first quarter adjusted earnings per share jumped 44% to $2.44, higher than expectations. So it was a pretty good earnings beat. Salesforce left its fiscal 2025 revenue forecast unchanged, but cut its operating margin expectations to 19.9% from its prior forecast of 20.4%. It's a little bit of margin compression going on here. Despite Data Cloud's promise, an uninspiring growth narrative and decelerating margin expansion have investors pumping the brakes on the global leader in application software, Third Bridge analyst Charlie Miner said. Salesforce COO Brian Millham said the company continues to see elongated deal cycles and budget scrutiny by clients. I don't know so much what an elongated deal cycle is. I guess they're saying slowing in sales. Budget scrutiny by clients, that's not a good sign. The company reported first quarter revenue of $9.13 billion, higher than a year ago, but below expectations of $9.18. It expects adjusted EPS of 234 to 236 per share in the second quarter, compared with estimates of 240. So we got weak guidance, slowing growth, worries about budget scrutiny by clients. Guys, this sounds an awful lot. Not so much, again, the mainstream press was trying to say, yeah, AI is starting to steal business from Salesforce. That's not what's going on here, guys. This is the white collar economy is slowing down. There's just fewer office workers, and so they need fewer licenses for office software. And we saw the same thing with Workday stock last week. Just a reminder about this one. Workday stock plunges amid soft subscription revenue guidance. And you can see it right here in this article. The company lowered its full-year subscription revenue forecast, citing elevated sales scrutiny and lower customer headcount growth. That is exactly what Salesforce just told us. Cloud software is just not as in demand as it used to be. It's starting to slow down. And Salesforce, by the way, down 16.5% ahead of the opening bell, trading at $226.60, down $45 this morning. And also, we got this one here. This story really had me laughing. UiPath shares tank 30% after company announces a CEO shakeup. UiPath shares plunged more than 30% on Wednesday after the software company said CEO Rob Enslin is resigning effective June 1st and being replaced by co-founder Daniel Dines, who stepped down as co-CEO on January 31st. And I'm telling you guys, when you see co-CEO, when you're researching a company and you see the phrase co-CEO, run, do not walk for the exits. Danger, danger. I have seen so many things blow up that involve the co-CEO. I'm convinced the UiPath will continue to define what's possible for our customers and partners in the AI and automation market, Enslin said, adding his decision to resign came after much reflection. Dines co-founded UiPath in 2005 with Marius Turca. The company makes software which automates repetitive and menial tasks, but its stock has suffered under Enslin's sole leadership. Shares are down 26% year to date after the company debuted in 2021 in one of the largest U.S. software IPOs ever. The company reported fiscal first quarter earnings on Wednesday, with revenue growing 16% year over year to $335 million, better than the consensus of $333 million. Guys, this is a $10 billion valuation company with revenue of $335 million. This is another one of those cases of 30 times sales, this thing being valued at. What are you, drunk? Who pays this kind of price for any company? That is insane. 10 times sales is insane. 30 times sales is on a different freaking planet. UiPath's loss per share improved to 5 cents. They don't even make a profit. Loss improved to 5 cents per share compared to 6 cents per share a year ago. So that's great. In 30 years, they'll be making 25 cents a share. Finance chief Ashim Gupta also warned the sales cycles for larger multi-year deals were elongating and customers were subjecting UiPath to increased deal scrutiny. Well, there's that elongated cycle and that deal scrutiny again. That's the same shit we heard with Workday. That's the same thing we heard with Salesforce. It's almost like the economy is slowing down, and it doesn't matter how many times you say AI, these companies don't make money. And those factors, along with the leadership reshuffle, weighed on its updated full-year guidance. The company lowered its guidance for the full-year revenue. It now expects revenue to fall between $1.405 billion and $1.41 billion, compared to its prior quarter guidance of $1.55 billion to $1.56. So they're lowering their guidance also. UiPath is currently down 30.1%, trading at $12.79. That's down $5.53 this morning. Bad news for Cathie Wood, who just yesterday, we saw this article, Cathie Wood goes bargain hunting. Here's the 3 stocks that she bought. When she was bargain hunting, she bought UiPath at 30 times sales. That was the bargain that she hunted for. Cathie, time to have those gigantic glasses looked at there. I'm just saying, 30 times sales doesn't look like a bargain to me. Cathie Wood just announcing she bought UiPath yesterday. Also, she also bought Roblox and AMD. So she's AMD's another one. She sold NVIDIA about 2 years ago, and now she's buying AMD after running up, and she's buying UiPath right before a 30% drop. Good luck, Cathie. Good luck, ARK investors. UiPath, again, we said down 30%. Now let's shift gears here a little bit to the banks. We've got Bank of the Ozarks share slide the most since 2020 as Citi cuts it to sell, and why it is commercial real estate that's hurting these banks. Shares in real estate project lender Bank of the Ozarks fell the most in 4 years after an analyst dealt the stock a double downgrade, citing concerns over a pair of its loans. There are two loans in particular. The company has had its name associated with skyline-altering commercial development projects with minimal total loss content. Gerlinger wrote in a note to clients, however, we have newfound but substantial concerns with what we believe to be Ozark's largest individual loan, a multi-use project in Atlanta, and life science construction lending in general. For the San Diego project, the research and development district, Gerlinger noted a dearth of leasing that's indicative of a difficult life science construction lending market. He also highlighted a lack of interest related to office leasing as a concern for the mixed-use development in Atlanta. These two loans combine, this life sciences project in San Diego and this mixed-use development in Atlanta, is more than $1 billion of Bank of the Ozarks loans. There's no leases at all in this San Diego life sciences project that they're building. None. They haven't been able to lease a single square foot of it. And they're saying an overall lack of interest related to office in Atlanta doesn't bode well for that project. So we got a double downgrade for Bank of the Ozarks yesterday from Citi, and that stock ended up dropping 14.25% yesterday to $39.60. I would add it is up 0.5% this morning ahead of the opening bell, however. We're going to blow through a couple of banks here to save time. We also had BMO, that's Bank of Montreal, shares sink as the bank signals that credit pain will persist. So now we're into the Canadian banks here a little bit. We expect that the delay in central bank easing of monetary policy and slowing economic activity could keep impaired provisions at around these levels over the next couple of years. Bank of Montreal increased their provisions for credit losses tied to commercial real estate. And they're saying, hey, if the central banks don't start cutting rates soon, that's going to be a problem for Bank of Montreal. And in my opinion, it's got nothing to do with rate cuts. I don't think rate cuts are going to save commercial real estate. Certainly not going to bring people back to the office any faster. This analyst, Doug Young, downgraded his recommendation on Bank of Montreal to hold from buy and cut his target to $129 from $133. A higher for longer interest rate environment is having a negative impact on borrowers, specifically in BMO's commercial loan book. There's commercial real estate again. He wrote in his note to clients. Young pointed to several large impairments tied to just a handful of loans in Bank of Montreal's commercial book. This is starting to sound a lot like New York Community Bank's warnings, noting that those added to the outsized increase in provisions, a factor Agarwal also mentioned during the conference call. Credit conditions for consumers and businesses have continued to weaken, and Toronto Dominion Bank and Bank of Nova Scotia each put aside more than $1 billion Canadian for potential bad loans in the quarter. National Bank of Canada, which reported its results on Wednesday, said it set aside $138 million in credit losses in the second quarter, more than the $131 million forecast by analysts. Now, here is Bank of Montreal. They were down 9.5% yesterday on that news, although they too are up about 0.6% this morning. Now we've got RBC. Now we're flipping the script a little bit here. RBC tops estimates as profit surges in capital markets decisions. So Royal Bank of Canada is doing the opposite here. RBC beat analyst estimates on strong performance from the company's capital markets business and lower than expected provisions for potential losses. Now, guys, I just got to say, when I see lower provisions for potential losses, right now delinquencies are on the rise, at least here in the U.S., and therefore I'm assuming it's the same in Canada because the two economies are very intertwined. We're seeing delinquencies rise in almost every category. We got consumer loans are on the rise fast, delinquencies. Foreclosures, still very low, but on the rise. Commercial mortgages, forget it. Commercial mortgages are exploding higher. The only thing that isn't rising is student loans, and that's because the government is saying you don't have to pay them back. So when I see banks beating earnings on lower provisions for credit losses, to me, that looks like guys sharpening their pencils at the end of the year just to make things look a little better. You know, oh, well, we'll set aside less money for losses. And guys, just so you know, the last paragraph in a Bloomberg article, it rarely disappoints. We got this one for Royal Bank of Canada. They fired their CFO, Nadine Ahn, a shock exit that came after the bank said she'd violated its code of conduct by having an undisclosed close personal relationship with a colleague who was given preferential treatment. Catherine Gibson was named interim CFO. So we've got a bank who is cutting their credit losses, their provisions for credit losses, at a time when delinquencies are on the rise and their CFO is getting fired for having an affair with a coworker and a new CFO is stepping in. I'm sure everything is just fine at RBC. Don't worry about that. That stock is up 1.4% this morning, trading at 104.33. And last of the banks today, we got CIBC tops estimates as provisions come in lower than expected. Not going to get too far into the weeds on this one, but this is another Canadian bank lowering their credit provisions, making their earnings look better, just like RBC did. CIBC Bank, they're up almost 2% this morning. So a mixed bag in banks. We've got Bank of the Ozarks getting crushed by these two commercial real estate loans. We got Bank of Montreal, Toronto Dominion Bank, Bank of Nova Scotia, all big increases in their credit loss provisions, driving earnings lower. And then we've got RBC and CIBC actually cutting their provisions for losses, even though the RBC CFO just got fired for having an affair. I'm sure nothing to worry about over there. So interesting things going on in Canadian banks this morning. Now let's shift gears to retail a little bit, guys. And here's one for the deflationists among you. Walgreens to cut prices on over 1,300 products as stock keeps sinking. Walgreens Boots Alliance said Wednesday it was continuing to lower prices as part of its Summer of Savings promotional campaign, this time on more than 1,300 products. But that announcement didn't stop the drugstore chain stock from falling toward a 27-year low. Walgreens understands our customers are under financial strain and struggle to purchase everyday essentials, said Chief Customer Officer Tracy Brown. We continue to be committed to our customers by lowering prices on over 1,000 additional items, something we've been doing since October of 2023. So what she's saying here is we know nobody can afford to buy our stuff, and so we're going to lower our prices so we don't go out of business. And in order to save face, we're going to pretend to care about you and your family, even though we're really just worried about losing market share to other companies that are doing the same thing. The announcement by Walgreens comes about a week after Target said it was cutting prices on 5,000 items, and 2 weeks after Walmart said there was deflation in the general merchandise categories as price rollbacks increased. So, guys, look, there's two ways you could look at stories like this, all right? You could look at this and you could say, this is great news for stocks because this shows that the consumer is tapped out and that inflation prints are going to start coming in lower because all of these price cuts are going to eventually show up in CPI, and low CPIs means the market celebrates because lower interest rates, Zerpenberg coming back, and the Fed will bring back the easy money. Or there's another way you could look at this and you could say stocks are screwed here because it's obvious nobody can afford to buy anything anymore. And sooner or later, that's going to start showing up in company earnings. Right now, the bad news is good news narrative continues to dominate this debate here. But sooner or later, bad news will become bad news again. And I've been saying for a while, I think 4.5% in unemployment is where that actually happens when people realize, oh, crap, the Fed is cutting interest rates and unemployment is still going up. It's transitory all over again. The Fed missed it again. That's when I think things really start to get wild in the market. But Walgreens Boots Alliance is actually up 2 cents right now, or 0.13% higher on this news. Also in retail this morning, Kohl's getting clobbered. Kohl's stock plummets 20% after massive earnings miss. There's another retailer who is struggling here. Kohl's shares plummeted more than 20% in pre-market trading Thursday after the company posted a surprise loss per share, coming in well below Wall Street expectations for a slight profit. Loss per share was 24 cents versus an expected profit of 4 cents. Revenue was $3.18 billion versus $3.34 expected. Big miss on top and bottom lines. Kohl's reported a net loss of $27 million, or a loss of 24 cents a share, compared to a year ago profit of $14 million, or 13 cents a share. Net sales decreased 5.3% to $3.18 billion compared to a year prior, with comparable sales down 4.4%. Remember, those comps are not adjusted for inflation, so you can add another 3.5 to that. You're looking at almost 8% decline in stuff being sold at Kohl's. And the company also lowered its 2024 guidance. It now expects full-year net sales to decline between 2 and 4%. Wall Street analysts polled by LSEG had been expecting 2024 sales guidance of a 0.2% gain. Kohl's expects full-year diluted earnings per share in the range of $1.25 to $1.85, far lower than the $2.34 per share that was expected. We recognize we have more work to do in areas of our business, CEO Tom Kingsbury said in the release. We're approaching our financial outlook for the year more conservatively, given the first quarter underperformance and the ongoing uncertainty in the consumer environment. Coal stock getting clobbered here, down 23.33% here. The opening bell just rang $20.81 for Kohl's. It's down $6.44 and falling. We also got some bad news from Best Buy this morning, although the market appeared to like it. Best Buy extends streak of quarterly losses as Americans direct more money to essential purchases. They're not buying consumer electronics here. Best Buy reported another quarterly drop in sales as the nation's largest consumer electronics chain wrestles with cautious spending by Americans as they prioritize essential purchases and pay more for things like rent. It's the best economy ever. The company has reported quarterly sales declines for more than 2 years, a stretch reaching back to the pandemic when households were bulking up on new laptops and other goods to work from home. Best Buy reported a profit of $246 million or $1.13 per share for the quarter ended May 4th. That compares with a profit of $244 million or $1.11 per share in the year-ago period. Adjusted EPS was $1.20, easily topping Wall Street expectations for $1.08. Sales fell to 8.85 billion from 9.46 billion, and we're short of the 8.96 billion the industry analysts had expected. So we got a revenue miss here despite the earnings beat. Comparable sales, those from established online and physical store channels, dropped 6.1%. Now, it looks like those comps, that's a terrible number. A 6.1 decline in same-store sales is just terrible. But to put that in perspective, a year ago, that was 10% decline in same-store sales. So I guess this is a less terrible report from Best Buy, and maybe that's why the stock is up 11% right now. That is amazing, an 11% increase in Best Buy. I guess there was just a lot of bad news baked into the cake here. See, I didn't see any good news. Yeah, the earnings, the adjusted earnings beat, but revenue missed. Comps are down high single digits. I don't see it here, but Best Buy stock is rallying. And another head scratcher, we got Foot Locker stock sprints higher after profit beats expectations by a wide margin while revenue fell by a short. Let's see. Shares of Foot Locker were higher in pre-market trading Thursday after the athletic shoe and accessories retailer reported fiscal first quarter profit that beat expectations by a wide margins while sales fell a bit short. Now, this is pretty similar to what we saw from Dick's Sporting Goods yesterday. Sneakers and athletic apparel were driving big numbers from Dick's yesterday, and we're seeing something similar from Foot Locker, a mall stock doing well. Imagine that. Same-store sales fell 1.8% to beat the FactSet consensus of 1.9% decline. And for fiscal 24, the company affirmed its guidance ranges for adjusted EPS of $1.50 to $1.70, for net sales to be down 1% to up 1%, and for same-store sales to be up 1 to 3%. And maybe it's that guidance for same-store sales to be up 1 to 3% is why Foot Locker stock is rocketing higher. Look at this, up 27%. I don't know, maybe we got a little bit of a short squeeze going on here. That's an oversized reaction here. Guys, this is a mall stock and the mall is still dying. So I don't expect this rally in Foot Locker shares is really going to last that much longer. But a lot of negativity baked into the cake for names like Foot Locker and Best Buy. So those shares are rallying. Meanwhile, Kohl's is getting destroyed. UiPath is getting destroyed. Kathy Wood not having such a good day over there. Things are kind of all over the place in the market here, aren't they? And I just want to say thank you so much to Steve Whitus for the super chat, sir. He says, regarding Salesforce, sales staff spend more time doing data entry and making reports instead of customer-facing sales activity, hence doing less sales. Let's see, the staff spends more time doing data entry and reports instead of customer-facing sales. That could be driving less sales. I mean, look, overall, Steve, I think this is just a reflection of the white collar headcount reduction that we're seeing overall. Starting, with last year, every company that announced white collar layoffs, office employees losing their jobs, we've seen those stocks rally. And so when CEOs see, hey, when I lay people off, the market rewards me, more and more CEOs start laying people off. And we've been getting a lot of anecdata about white collar jobs going away. We saw more than 1 million full-time jobs disappear last year, replaced by lousy part-time work. And, well, as those full-time jobs go away, as those white-collar jobs go away, you don't need to pay for office software, and Salesforce makes their bread and butter off of office software. So I don't think this has anything to do with AI. As far as them doing more time, the staff spends more time doing data entry. That cloud data is a big thing Salesforce has spent a lot of money on, but they're saying it's going to take a while for that to develop any revenue or actually make them any money. I think this is just overall indicative of the white collar recession, seeing the same thing from UiPath. We're seeing the same thing from Workday, talking about the elongated deal cycle, whatever the hell that means. 3 different companies have said it. Scrutiny, reduced headcount. Those are things that we've heard. Sales scrutiny, deal scrutiny. It's just the white collar recession here is what I think is going on. Thank you so much, Steve, for the super chat, the support of the channel. And thank you to my man, Mighty Mike, who says, Jack, no more tinfoil hat for AI. Thanks. Do we not need the tinfoil hat? Is it no longer a conspiracy theory to say that maybe the valuations of these companies have run a little wild, and that sooner or later, if a company doesn't actually make money, which is the point of companies, is to make money, then you won't really have many companies? Isn't that what sank the dot-com bubble? You had Cisco and Sun and all the companies were building out the hardware and selling thousands of miles of fiber optic cable, anticipating all the dot-coms becoming the next big thing. And then whoops, the dot-coms never made any money. And so all these companies that were selling all this hardware, suddenly their stocks crashed down to earth, valuation, some of them by 80, 90%. Wow, isn't that very similar? It's almost word for word what's happening right now. Oh, and by the way, CoreWeave is filing for their IPO. I didn't even mention that one. Yeah, CoreWeave is looking to IPO by 2025. So everybody get in line to buy Magnetar's bags when that one happens. I'm sure that's going to end really well for people who buy that stock. Nothing shady going on over there whatsoever. Thank you so much, Mighty Mike, for the super chat and the support of the channel, sir. You are a gentleman and a scholar. And thank you, everybody, for having your coffee with the Melonheads this morning. A lot going on in the world today. It's going to be another one of those sell everything and buy NVIDIA days, it looks like. Thank you so much to my channel members and Patreon supporters for everything you guys do to support the channel. I got links down below, all that good stuff, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, until tomorrow, live small and dream big.